So, you've probably heard the whispers. A huge market crash is supposedly coming in 2026. Global recession, panic, the works. But here's the twist. At the exact same time, some local economies are showing signs of a massive boom. So what's really going on? Is the world about to fall off a cliff, or are we missing a huge opportunity right under our noses?
A lot of this anxiety, and believe me, there's a lot, comes down to this one thing, the banner chart. Now, this isn't some newfangled algorithm. It was created by a farmer and analyst named Samuel Banner over 100 years ago. And the crazy part? It has been scarily accurate at calling major market cycles. And guess where it's pointing right now? Yep, directly at 2026 as the mother of all crashes. But come on, can we really bet the farm on a century-old chart? Let's find out.
Okay, so to figure that out, we've got to look at why anyone takes this thing seriously in the first place. And really, it all boils down to its track record. Just look at this. The chart nailed the 1999 dot-com crash. It basically screamed, sell your assets in 2007, right before the massive financial crisis. It even flagged the panic we all remember from early 2020. So when a chart with a history like that points to 2026 and says, this is the next great time to sell, yeah, you can see why people are paying attention. All right, so a creepy old chart is one thing, but let's get real. Let's deconstruct the actual global risks people are talking about. What are the economic arguments that are really fueling this fear? We're going to break down the biggest ones, and we have to start with the topic that's on everyone's mind, AI. You know, a lot of people are saying, oh, this AI thing, it's just the new dot-com bubble. But well, it's just not right. The dot-com crash was all about a massive oversupply. Think about it. Companies spent $2.6 trillion laying down all this fiber optic cable, this dark fiber, that nobody even used. It was a classic, build it and they will not come. Today's AI boom, it's the complete opposite. It's a story of insane undersupply. Companies like NVIDIA are literally printing money because they cannot produce chips fast enough to meet the demand. They're actually raising prices. This isn't a bubble built on pure hype. It's a boom built on real, hungry, unmet demand. Okay, fear number 2, a total collapse in corporate earnings. Sounds bad, right? Well, when you actually look at the consensus forecasts, they tell a completely different story. We're not looking at a slowdown. In fact, most experts are projecting recovery and growth for 2026. Why? Well, the U.S. economy is expected to get a little stronger, and pretty much everyone is expecting interest rate cuts, which is like a shot of adrenaline for corporate profits. And where's this growth coming from? Exactly where you'd expect, future-proof sectors like tech, healthcare, and biotech. All right, I hear you. What about the absolute elephant in the room? The massive, terrifying U.S. national debt. Isn't that the ultimate ticking time bomb, just waiting to blow up the whole system? Well, it's a little more complicated than that. So what's this number, $888 billion? This is the current market value of a massive and kind of hidden asset on the U.S. government's books. I'm talking about 8,133 tons of gold. That is a mountain of gold, more than any other country on the planet. And here's the kicker, the part that most people totally miss. The U.S. government has this, let's call it, a trick up its sleeve. Because of some random law from way back in 1973, they officially value all that gold at just $42 an ounce. 42. If they decided tomorrow to revalue it at today's prices, bam, they'd instantly unlock almost $1 trillion in asset value. It's this wild accounting lever they can pull to help manage their debt. So, this idea of an imminent default may be not the slam dunk threat people think it is. And that brings us to the last big global fear, China. What if China decides to dump all its U.S. Treasury bonds at once to crash the economy? Sounds terrifying, right? A real geopolitical weapon. But when you look at the actual numbers, the threat just evaporates. China holds less than 3% of the total U.S. Treasury market. Yeah, less than 3%. If they sold it all, would it make waves? Sure. But could it crash the entire system? No way. It's just not a big enough piece of the pie. Okay, so if the big arguments for a global crash are looking a little shaky, what's actually happening on the ground? Well, this is where the picture gets way more interesting and a lot more complex. Let's zoom in on a market like India, because it is in a really unique spot right now. Think of the Indian market as being in this giant tug of war. On one side, you've got these global headwinds, things like U.S. tariffs that create a ton of uncertainty for companies that sell stuff overseas. But on the other side, pulling just as hard, is this powerful domestic tailwind, a massive internal push from government stimulus, and this push and pull creates what the pros call a range-bound market. The overall market might look kind of flat, but underneath the surface, it's the perfect environment for specific stocks to just take off. So what's powering this domestic tailwind? It's really a three-pronged attack. First, you've got fiscal stimulus. We're talking income tax cuts. Second, monetary easing, which is just the central bank making it cheaper to borrow money. And third, there's a huge proposed cut to the goods and services tax, the GST. You put all three of those together, and they're designed to do one thing and one thing only: get people inside India to spend money. Okay, now this is where the story takes a really fascinating turn. Remember that AI revolution we talked about? The one driving a massive global boom? Well, that same exact revolution is being seen in a completely different light inside India. So, on the global stage, people like Srivastava are saying AI is this incredible demand-driven boom. The play is to invest in the huge US tech giants that are creating the technology. But when you look at India, people like Bayard are saying something totally different. For India's giant legacy IT services companies, AI isn't a boom, it's a crisis. These are the companies that have made billions doing routine coding and support for decades. And now, AI is coming to automate their entire business model. The ones that haven't innovated are staring down the barrel of mass layoffs and, frankly, collapsing valuations. As investor Gautam Baid puts it, their very size has become a problem. These huge Indian IT firms got slow. They got comfortable. They spent years just coasting and collecting checks instead of actually innovating. And now, AI is here to eat their lunch, and they're just not agile enough to fight back. So that leaves you with a big question, right? If India's traditional tech giants are in trouble, how on earth do you invest in the AI theme there? Is there a way to play this massive global trend from within India? Well, the answer is yes, but it's not what you'd expect. The real play is an indirect one. The answer is power, as in electricity. See, all those AI data centers are incredibly thirsty for energy. They are insanely power hungry. The demand for electricity to fuel this AI revolution is just skyrocketing, and that is creating a huge multi-year boom for any company that generates power or builds the stuff needed to move it around. Transformers, power lines, the whole shebang. So, when we zoom back out and look at the whole picture, what do we see? We don't see a world heading for one big, uniform crash. We see a world of divergence, a world with very clear pockets of risk, side by side with incredible pockets of opportunity. So let's just lay it all out. Globally, the growth story is pretty clear. It's in those dominant AI monopolies and reliable sectors like healthcare and biotech. But when you look at a local market like India, the opportunities are totally different. It's all about what's happening inside the country. We're talking consumer goods getting a boost from tax cuts, popular items like SUVs, and a big recovery in the rural economy. And then, on a thematic level, cutting across everything, you've got hard assets like gold and copper, and the big one, the power sector, that's fueling this whole tech revolution. So, what's the final takeaway here? Maybe we're all asking the wrong question. Maybe it's not, will there be a global crash in 2026? Maybe the real story is this great divergence. This incredible idea that a massive innovation in one part of the world can create a genuine crisis in another. It forces you to look past the scary headlines and see the incredibly complex and fascinating global economy we're all a part of.